Hi, welcome to KBRA's newest Sovereigns podcast episode. My name is Joan Feldbaum-Vidra, and I look after sovereigns for KBRA. Today, we'd like to update you on some recent developments as they relate to emerging market sovereigns. Several dynamics are underway that have a generally negative near-term impact on emerging market growth, but there's also a lot of resiliency in emerging market credit. In this podcast, we will discuss the headwinds for EM growth, namely China's slowdown, accelerating inflation, and the beginnings of shifts in monetary policy from global central banks. And of course, there are also uncertainties over the virus and contagion. Second, we'd like to highlight how the policy environment in select emerging markets is also starting to shift in response to the macro realities. And third, we'll also remind you of a theme we've discussed in earlier research that we've done at KBRA, which is the improvement in many emerging market credit profiles and their improved resilience to the negative impacts of a Fed taper. And as we discuss these points, we'll weave in some comments that help us all make a quote-unquote reality check. So let's start with the headwinds for growth. Actually, taking a pause here, let's start with the reality check. The context of these headwinds to growth is that actually emerging markets for the last few months had been upgrading their growth forecasts over the recent period. So any downward adjustments that might be made right now are from a more favorable position. And those upgraded forecasts as of late relate to the pickup in global demand, commodity prices, the vaccine rollout, even though a lot of that's been uneven. But now that we've got that reality check out of the way, let's go on to the headwinds. First, there's China's orchestrated slowdown. China's slowdown is especially important when one considers that that country consumes about half of global commodities of certain sectors. And next, there's the inflationary environment. Just as China's recent PPI print revealed, Chinese goods are getting more and more expensive, and that contributes to the pickup in inflation globally, including in emerging markets. We also have food price inflation, which we've all noticed. That's accelerated by about 30% over the course of COVID based on many estimates. And poorer economies, largely in the emerging markets, whose consumption baskets are more heavily weighted towards food and shelter, feel the pain even more. I'm going to take the opportunity to pause again for a reality check. These inflationary impulses that we're witnessing right now are not putting countries in the danger zone like in the past. Global inflation has come way down. Even considering the inflation we're experiencing at this stage of the pandemic, this is not rampant runaway inflation. And on to the third item that is exerting pressure on growth. That is central bank activity. Central banks are starting to slowly move towards normalization. We've been attuned to that from recent comments at the Jackson Hole Conference by Powell and also Lagarde's comments in regards to the latest MPC meeting. New Zealand and Canada have been early starters towards strides towards monetary policy normalization, and we've even had rate hikes in certain corners. Korea was the first out the door to hike rates with a 25 basis point hike in August. Its base rate returned to 0.75%. So while the movement is there, again, here's another opportunity for a reality check. Despite central bank activity and the hike to 75 basis points, Korea's base rate is still below pre-pandemic levels. The movements are important, but so are the magnitudes. Now, on to the reaction of emerging markets. So far, the reaction has been somewhat muted, but it is accelerating. We've seen rate hikes quite a lot in Latin America. That's not too much of a surprise, given that those financial market dynamics in those countries are more volatile, but also elsewhere. Here's the list we've assembled of emerging markets that have hiked rates, including a few that have hiked a few times. And just a caveat here, there's more to come. So far we have Chile, Brazil, Mexico, Peru, Turkey, Hungary, Georgia, Ukraine, and Russia on our list. Absent to date is Colombia in Latin America. So what's behind those rate hikes? Well, it's a combination of inflationary pressures and homegrown risks. So let's take a look to see if there's an opportunity for reality check here. And to do this, let's look closely at some of these countries. On the one hand, you have Brazil, whose base rate is now 4.25% versus 4.5% pre-pandemic, while inflation is running now close to 10%. Peru just hiked for the first time to 1%, but it still is considerably below the pre-pandemic level of 2.25%. Inflation is kissing 5% in Peru, higher than it was pre-pandemic. Chile has made 2 hikes and now is closing in on its pre-pandemic base rate level. The rate is now 1.5% versus 1.75% pre-pandemic, with inflation exceeding pre-pandemic levels too. And then Mexico is yet another case in point. After several rate hikes this year so far, the base rate is presently at 4.5%, still well below the pre-pandemic level of about 7%, if my math is right. And as is the case for all countries that have hiked rates, accelerating inflation is the motivation. So there's probably another opportunity for a reality check here. What are we talking about? In general, these hikes are contained still at this point. There's more to come, but they are contained. In general, rates are still below pre-pandemic levels. But also what's interesting here is that for several countries in the EM universe, particularly in Latin America, that ethos of getting in front of the rate hike curve, or at least in front of the advanced economies' rate hikes, is something that's definitely been demonstrated. And what we think here at KBRA is that reflects very strongly on the independence of the central banks, which is a key policy pillar in these economies. Being ahead of the curve here could serve them well. So interest rate hikes certainly quell growth and recovery, especially in countries where monetary transmission is higher. But what is working in emerging market countries' favor? Well, one interesting observation is found in their real effective exchange rates. In many emerging market economies, those have weakened. We've discussed that dynamic in several earlier research pieces at KBRA, but the same trends still apply. Those real effective exchange rate weakness should help those economies sustain their competitive edge and help them sustain export-led growth. That data also suggests that there is room for appreciation that comes with rate hikes without stifling growth. So what are our main takeaways? The first are the unknowns. China remains the elephant in the room, as does virus contagion and the Delta. Should China's growth slow seriously down, this will be hard felt for emerging market economies. Interest rate hikes are also a risk, but many central banks in the emerging market space, or at least a few, have gotten ahead of the curve. That proactiveness may serve them well in an environment of tightening global credit. And finally, we've highlighted improved exchange rate competitiveness in emerging markets, a feature that is broadly generalizable to the asset class that could support their growth profiles. So in sum, while there's some negative trends for emerging market growth going forward, we've tried to intersperse our discussion of those risks with some reality checks about where we are today versus where we were in the past, and room for resilience. Thank you so much for joining us for today's Sovereigns podcast episode. Please reach out to us if we can answer any questions, and have a nice day.